Investor expectations for ESG. Disclosures play a vital role in measuring and reporting ESG, environmental, social, and governance performance. As companies continue to recognize the importance of sustainable practices, investors increasingly consider ESG factors when making investment decisions. In this part of our ESG tutorial, we delve into the details of investor expectations for ESG disclosures, focusing on their significance within the broader context of measuring and reporting ESG performance. Investors have become more interested in the environmental, social, and governance aspects of companies because they recognize the impact these factors can have on long-term financial performance. Consequently, they expect companies to disclose relevant ESG information to enable informed investment decision-making. To meet investor expectations, companies should consider the following. A materiality. Investors expect companies to disclose material ESG issues that have a significant impact on financial performance. Materiality can vary across industries, and it is crucial for companies to identify and address ESG issues directly relevant to their operations and stakeholders. B. Transparency. Investors value transparency in ESG reporting. They expect companies to provide meaningful, accurate, and comparable data on their ESG performance, initiatives, goals, and risks. Transparent reporting enables investors to assess the sustainability of a company's business practices. C. Strategy alignment. Investors also want to understand how a company's ESG efforts align with its overall business strategy. They seek a clear link between ESG performance, risk management, innovation, and long-term value creation. Companies should articulate their ESG strategy and show how it aligns with their business objectives. The targets and performance metrics. To assess a company's progress, investors want to see concrete ESG targets and performance metrics. Companies should establish goals and monitor their performance against these targets. Effective targeting and measurement ensure accountability and demonstrate a commitment to continuous improvement. To fulfill investor expectations, companies often rely on established ESG reporting frameworks. These frameworks provide guidance on reporting specific ESG information consistently and comprehensively. Two widely recognized frameworks are the Global Reporting Initiative, GRI, standards, and the Sustainability Accounting Standards Board, SASB, standards. A Global Reporting Initiative, GRI, standards. The GRI standards provide a comprehensive framework for reporting on a range of ESG topics. The framework emphasizes materiality, stakeholder engagement, and the disclosure of management approaches and performance indicators. B. Sustainability Accounting Standards Board, SASB standards. The SASB standards focus on industry-specific material factors that can impact financial performance. These standards help companies identify and disclose financially material ESG issues that are most relevant to their industry. When adopting reporting frameworks, companies should ensure that the selected framework aligns with their business objectives and adequately covers the ESG topics of interest to investors. In addition to reporting frameworks, companies need to consider effective communication channels to disseminate ESG disclosures to investors. Key channels include annual reports. Many companies integrate ESG performance information into their annual reports to give investors a comprehensive overview of their financial and non-financial performance. This approach presents a clear connection between ESG initiatives and financial outcomes. B. Standalone ESG reports. Some companies choose to publish standalone ESG reports to provide a more detailed account of their sustainability initiatives, performance data, goals, and targets. A separate report emphasizes the significance of ESG issues and demonstrates a company's commitment to transparency. C. Corporate websites. Companies often share ESG information on their corporate websites to facilitate easy access for investors. Creating a dedicated ESG section on the website presents company commitments, ESG policies, performance reports, relevant news, and frequently asked questions. To meet investor expectations, it is crucial for companies to ensure the credibility of their reported ESG disclosures. Several measures can enhance credibility. Independent verification. Engaging third-party assurance providers to independently verify ESG disclosures adds credibility to the reported information, reinforcing investor trust. B. Robust data collection and management. Companies must establish robust systems for collecting, managing, and reporting ESG data. Implementing rigorous internal controls and data validation processes enhances the accuracy and reliability of reported ESG information. See stakeholder engagement. Companies should engage with stakeholders, including investors, to understand their information needs, gather feedback, and address concerns. Regular dialogue with investors helps build credibility and ensures effective responsiveness. In conclusion, investor expectations for ESG disclosures are integral to measuring and reporting ESG performance. By understanding these expectations, companies can enhance their ESG reporting practices, meet investors' information needs, and demonstrate a commitment to sustainable business practices. Ultimately, thorough ESG reporting can attract and retain investors who consider ESG factors as crucial components of their investment decisions.